วัสดีค่ะยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัท PSL สำหรับไตรมาส 3 ปี 2023 นี้นะคะโดยเริ่มด้วยคุณคาลิด ฮาชิมกรรมการผู้จัดการของบริษัทจะนำเสนอข้อมูลในเรื่องของอุตสาหกรรมเรือเทกองและต่อด้วยคุณกอตัมคูรณากรรมการทางด้านการเงินจะนำเสนอข้อมูลในเรื่องของตัวเลขผลการดำเนินงานและในช่วงสุดท้ายคำถามคำตอบซึ่งถ้าท่านใดมีคำถามก็สามารถส่งเข้ามาได้ตามระบบทั้งภาษาไทยและภาษาอังกฤษนะคะค่ะแล้วเดี๋ยวเราจะตอบให้ในช่วงท้ายขอเชิญคุณคาลิดค่ะ
Thank you, Som. We will do the presentation in two halves. In the first half, we will cover the industry section, and then the second half, Gautam will take you through all the financials of the company. So, coming to the dry bulk freight market. So, if you look at the slide that is put up for you, you can see clearly that China did an excellent job in the first 9 months of this year. So, whatever number you look at, it is far above the last year's numbers, and even if you were to look at it on a 5-year basis, on an average of the last 5 years, it is still higher. So whether it's iron ore imports, coal imports, steel production, steel exports, and steel consumption, all these figures were really good for China. If you look at the next slide, it shows you how the last month of September went for the last quarter, and you can see that in terms of coal imports, it was up 28% year on year and up on a year-to-date basis of 73% and 37% above the 5-year average. If you look at iron ore imports, it was up 1% year on year and year-to-date was up 7% and 5% above the 5-year average. If you look at soybean imports, it was down 7% year on year, and year-to-date at 78.9 million metric tons was up 14% year on year, and so sorry, it's down 7% month on month, not year on year, and year-to-date it was up 79%, 78.9 million metric tons, up 14%, and up 9% above the 5-year average. So if you combine these three major bulk imports, you would see that it was 7% above the year-over-year numbers for iron ore, coal, and soybeans combined. If you then look at the next slide, we talk about what's happening with China and the slow economic recovery. The main problem with the slow economic recovery is that the Western media put a lot of emphasis on China's recovery post COVID-19 opening up, and because China did not perform to the expectations of the Western media, they had to then put a story out to say that China has performed very badly. In terms of growth, there was positive growth on the dry bulk imports and exports, which I've already shown you. However, Country Garden is the second large real estate developer that is currently in default. In terms of the imports that China was focusing on, you can see that they were focused mainly on energy security and food security. Similarly, many other countries also doing the same thing. In terms of imports, iron ore and some metals like bauxite and nickel ore were still strong despite the weak real estate sector, and this was made up by the electrical vehicle manufacturing and export industry in China and shipyards. They are building, they are the number one shipbuilders in the world today. Coming to exports, they faced challenges because the rest of the world's GDP was not faring as well as China's GDP. So therefore, exports did not do as well as the dry bulk markets. China, of course, is behaving in a very fiscally responsible manner and is not overstimulating the economy on steroids this time around. In the first 9 months, GDP growth was at 5.2%, and IMF just yesterday upgraded China's GDP growth to 5.4%. Coming to the next slide, coming to India's performance. India's performance in the first 8 months of this year. If we look at India's performance in the first 8 months of this year, you can see clearly that iron ore exports in India went up dramatically by 109%. India's wheat exports actually were down by 99%, and that is because India banned the export of wheat. If you then look at rice exports in the first 8 months, it was down by 6% compared to last year. Once again, because in July, the Indian government banned the export of rice. Then coming to steel production was up by 6.4%. If you look at steel imports was up by 27%. Look at steel exports was down by 18.1%, and steel consumption was up by a massive 9.1%. So again, the second largest economy in Asia, India, was doing really well. Coming to the overall trade development in billion ton miles, if you focus on 2023, you can see that Clarksons are now showing it as 4.6% growth rate, and against that they're showing a fleet growth of 2.9%. And if you look at the forecast for 2024, it is at 1.8% for demand and 2.2% for supply. If you look at this chart, it shows you how much Clarksons are changing their forecast. So if you look on the left-hand side, it shows you what they predicted for demand growth. That is the first bar, the lighter bar. It was shown as 1.59%. And if you look at the second bar, which is there, 1.59% is the growth in ton mile demand, and the second bar was for the growth in tonnage. So they showed it as 2.4% for the year. That was the prediction in Jan. By March, they had revised the prediction up to 1.92% for the growth in demand and 2.70% for the growth in supply. And finally, in October now, they're showing it as 4.59% for demand growth and 2.9% for supply growth. Please keep in mind, this is before the prediction was made by, or the revision by IMF to increase China's GDP growth rate for 2023 to 5.4% as compared to 5%, which was the previous estimation for China's GDP growth rate. So if IMF is increasing their GDP growth rates for China, I am sure Clarksons will also come back and increase in the next one. When we get the final year's results, they will show that demand has grown by even higher than this 4.6% that they're predicting now. On the right-hand side, it shows you the picture for 2024. If you look at this slide, it shows you that for the handy-size and the Supramax sector, you can see Supramaxes are 54% dependent on minor bulks, and handy-sizes are 66% dependent on minor bulks. So we carry more of minor bulks than any other type of cargoes that are around. If you look at this slide and look at the lower portion of the slide, the last row and the last column, you can see that tonnage has grown in the first 9 months net position of 24 million deadweight tons, or roughly 2.45% of the existing fleet. If you look internally, you can see that the growth in handy-size and Supras was 2.32% and 6.32% versus Panamaxes at 6.22% and Capes at 8.77%. If you now look at the forward order book, it shows that the total order book is at 79%, and the percentage works out to 8% of the existing fleet as of 1st of October. And we've given you a breakdown on the chart below. If you look at this slide, it shows you the historical picture, what's happened for actual fleet growth, and the line on the top, this line, which just shows you this number of 78.14%. that is the forward order book at the start of each of these years. And you can see that in 2009, it had reached this almost 80% level. If you look at the curve today, you can see that for the first time, the red line is above the net supply side increase. So you can see that the 20-year-old ships, which is the red line, is now above the forward order book position, which tells you how many more ships will come up to the end of 2026. If you look at this slide, it tries to show you the differences at the various periods of time that the market was very, very strong, 2003 to 2009, very, very weak, 2010 to 2020, then 2021, 2022, and finally 2023. So if you look at, say, for example, the demand in billion ton miles on an annual basis, it was growing at 5.4% during the 2003 to 2009 period. Then it dropped to 4.3% in the 2010 to 2020 position. And now in 2021, it was up at 3.44%. 2022 was actually minus 1.53%. And now the latest forecast by Clarkson shows it at 4.6% for this year. Similarly, if you look at speeds, the average speed for the ships during this period of time was 13.5 knots. It dropped down to 11.5 knots during the bad period of time, and then further to 11.4 knots during 2021, 11.2 knots in 2022, and now 11 knots in 2023 as an average. Similarly, if you look at the annual net supply growth, it was strongest in the 2003 to 2009 period at 6.8% per annum. It dropped to 6.4% per annum in 2010 to 2020, and then to 3.6% in 2021, 2.9% in 2022, and again forecast at 2.9% in 2023. But the best part that you need to really focus on is that the 20-year-old fleet is larger than the forward order book. At the start of October 2023, the 20-year-old was at 8.26% versus 8.01% for the forward order book. So again, it shows you that the forward order book is just about going to be able to replace the older ships. This shows you the average speed. Again, it's in a bar chart form. I've already explained that to you. This shows you the congestion. So if you look at the congestion so far in the 9-month period, it is at 30.7%, very similar to the averages for the 7-year period. If you look at the 7-year period, 2016 to 2022, take this 7-year period, then the average is at 30.7%. And if you took it only for 5 years, that is 2016 to 2020, then you would see that it was at 29.9%. So not very different from what we have in 2023. Why was the forward order book so low? 3 main reasons. The first reason, of course, is that we got crowded out. Dry bulk did not order quickly enough, but LNG, containers, companies, car carriers, gas and tanker companies booked all the available slots. Now the earliest ship you can get for delivery is 2027. Shipyard capacity has fallen by 40% from the peak. And main thing is now there is this transition in fuel taking place, and nobody really knows whether if you buy an internal combustion fuel oil burning ship, whether it will become a stranded asset or not. So finally, coming to the key industry takeaways, IMF estimates global growth rates of 3% in 2023 and 2.9% in 2024. Chinese GDP growth has been upgraded to 5.4% by IMF just yesterday, up from their 5% forecast, which was there previously. And GDP growth actually in the 9 months was 5.2%. So it seems that China is doing much better than what anybody had forecasted. Demand growth of 4.6% has been forecasted by Clarkson for the whole of 2023. This was before the IMF increased the GDP growth rate for China. So we think this will also go up further. In the 9 months, in the first 9 months, China's fixed asset investments was up by 3.1% and consumer spending had rebounded. China's 9 months iron ore imports was at 878 million metric tons, up 6.6%. Brazil had a 20% share, Australia had a 63% share. Forward order book to fleet ratio at 8.01% is lower than the existing 20-year-old fleet at 8.26%. And the dry bulk fleet is forecast to grow at 2.9% in 2023. In the first 9 months, it actually grew by 2.45%. And in the last quarter, remember, growth rate is very slow in net supply because people don't want a ship in the month of December. Otherwise, it'll be 1 month old on the 1 year old on the 1st of Jan of the following year, and 2.2% in 2024. Net supply, according to Clarksons, will be reduced by a further 1.5% to 2% during 2023 and 2025, 23 to 2025, due to lower speeds while compliance with EEXI and CII regulations. Then the main factor now affecting the market is congestion at Panama Canal, congestion at South American grain ports, and steel consumption going up in China because of electric vehicles and shipyards taking up this space. So supply-demand balance continues to improve. So in that, what is our strategy? Our strategy is to remain where we are. We are not adding any ships. And if you look at us and compare our earnings per day per ship on the Handysize, we beat the index by almost 6%. And if you look at the Supras and Ultras, we beat the index by almost 2%. Keep in mind that our Handysize sector should be at a discount to the index ships by 25%, and the Supras and Ultras should be at a discount of about 10%. This is our forward order book. It tells you that we have booked as of the start of this year up to the end of 2026, we have about $210.2 million of net bookings. Coming to financials, Gautam will now take you through these slides.
Thank you, Khalid. So here are some highlights for the third quarter. For the third quarter, our net profit was about 98.44 million, or USD 2.7 million, or 6 satang per share. Our EBITDA was 432 million baht, or USD 12.26 million. We paid out the interim dividend number 2 that we declared at the end of the second quarter. This was in the amount of 5 satang. We paid this on the 8th of September. In terms of financing, we entered into 2 financing agreements. So on the 11th of August, we entered into a 26.25 million facility with the Export-Import Bank of Thailand. We also entered into a $105 million facility with International Finance Corporation on the 25th of October. This was International Finance Corporation, Exim Bank of Thailand, and Credit Agricole. In fact, just yesterday, we also announced that we've entered into another loan agreement, refinancing agreement with Credit Agricole of about $37 million. During the quarter, we extended the variable time charters for 7 of our ships. In addition, one of our vessels, the Patra Nari, it's a Handysize bulk carrier. She was fixed on a long-term variable rate time charter contract. So in aggregate, we've got 5 ships on long-term fixed rate time charters and 17 ships on long-term variable rate time charters that are linked to the underlying index for that vessel size. So some key figures for Q3 2023 and compared to Q2 2023. So our revenues for the quarter came in at 35 million compared to 39.1 million. This is in US dollars compared to 39.1 million in Q2. Our net profit for the quarter was 2.8 million compared to 8.2 million in the previous quarter. The earnings per share in baht was 0.06, so 6 satang compared to 18 satang in Q2. Our return on equity was 2.77% compared to 3.79% in the previous quarter. The net debt to equity ratio reduced slightly from 0.34 to 0.33 in the current quarter, and our fleet size remained the same at 38. So these, we show you over here 4 graphs. So the top left graph will show you the time charter rate per day per ship. that we've had for each of these quarters, starting from Q1 2020 until Q3 2023. So you'll see in Q1, Q2 2020, the market was quite badly hit from COVID-related disruptions, and then there was a recovery. And since then, so Q4 2021 was perhaps the recent peak in markets. Since then, markets rates have declined somewhat, but now they've somewhat stabilized. And while it's not reflected here, I would say September and October were relatively strong markets. What's getting reflected in the average rate over here is the relatively weaker rates that we experienced in July and August of this year. The graph on the top right shows you the historical EBITDA, the evolution of EBITDA over each of these quarters. Similar story to the time charter rate per day. The graph on the bottom left, we show you the dividends that we've been paying out. And the graph on the right, we show you the cash balance at the end of each quarter. So we ended the quarter with 33 million of cash on our balance sheet, which is up from 25 million in Q1 2023, but slightly below the Q2 figure of 35 million. So here's our statement of financial position. So at the end of last year, the vessels and equipment amounted to 638 million. And at the end of 30th September, this came down to 618 million on account of depreciation. Our shareholders' equity level remained more or less the same. It was 471 million at the end of last quarter. Our debt came down slightly from 194 million at the end of last year to 187 million currently at the end of the third quarter. Here we show you our cash movement in the quarter. So we started the quarter with 35 million of cash on balance sheet. We generated 15 million of cash from operations. We spent 3 million on capex, comprising mainly dry dock special survey expenses. We had debt repayments, prepayments of 10 million, interest payments of 3 million, which has remained fairly stable. Dividends we paid in the quarter were 2 million. And we also had a gain on the unwind of a interest rate swap of about 2 million. And so we ended the quarter with 33 million of cash on our balance sheet. So over here we show you the operating expenses, a breakdown of our operating expenses for our fleet. So operating expenses have remained fairly stable in Q3 2023 when you compare it to the operating expenses for Q2 2023. The variations that you see in there are not very material. And it's our expectation that operating expenses will remain fairly stable because many of these inflationary pressures that we experienced in 2021 and in 2022 have largely gone away. So over here we show you our operating expenses and G&A. We compare that with several of our listed peers and who also own Supramax and Ultramaxes. You'll see that in general we are close to the bottom of as far as our operating expenses plus G&A is concerned. The table below that, it shows you the EBITDA per ship that we earned and also what our peers earned in Q2 of 2023 and also for the last 12 months. So we have data until only Q2 2023. Many of our peers haven't reported results. So you'll see that we had the second highest EBITDA per ship for the last 12 months, meaning last 12 months ending the second quarter as such, given at 3.68 million per ship. So this is our debt maturity profile. So it is fairly flat, and we are making an effort to flatten it out further. We're extending the maturity so as to lower our cash break even. We've already entered into, as I mentioned, some refinancing agreements this year, and we will, well, as we sort of in the fourth quarter as well, we will potentially enter into some more financing agreements, and also in the first quarter of next year, potentially. Those will also help in reducing our cash break even and also increasing the maturity of our loans. So over here, we show you our net debt figures and the net debt to equity ratio over time, starting from 2012. So you'll see that from about 2013 until 2017, our debt increased as we took delivery of a number of new buildings during that period. We've of course paid back much of those loans, and our net debt is now down to $153 million at the end of the third quarter, and our the net debt to equity ratio is also at a very low level, about 0.33. So over here we show you, okay, so starting with the top line, we show you the average age of our fleet. So starting from the year 2000, the average age of our fleet was about 15.6, and it remained at more or less that level until 2011. And as I mentioned, we took delivery of a number of younger ships, and so the average age came down. It was at its lowest in 2016 at 5.8 years, and since then it has begun to creep up. It's currently at the end of the third quarter, it's 11.7 years. So the red line below that, it shows you the average size of ships in our fleet. So you'll see from 2000 to around 2011, we were mainly a handy size exposed company. And then since then, we also have gone into the larger vessel size segment. So we've gone into Supramaxes, Ultramaxes, and so therefore the average size of ships in our fleet has gone up. And it's currently at 43,621 deadweight on average, compared to 22,000, as I said, in the year 2000. And so in the year 2000, so the line below that, the dark green line, we show you the time charter rate per ship per day, the average time charter rate per ship per day on for our fleet. And you'll see again in 2000, it was 5,760, and then that started to move up as we had the super cycle years from about 2003 until about 2009. And then, as you have seen, the order book in 2009 was at 78%. Those ships got delivered between about 2008, 2009 until 2016, and that caused a gradual decline in rates. So the market bottomed out in about 2015-16, and thereafter the supply pressures have largely abated. And that's a big reason why we've seen rates start to move up, average rates start to move up. Of course, there's a lot of volatility in the rates because of the COVID years, but still, in general, the trend is certainly up. The line below that, we show you the operating expenses per ship per day, which, as you can see, is quite stable. So over here, we show you the dividends that we have paid over time, starting from the year 2003. Our policy is to pay not less than 25% of our net profit as a dividend. In general, we have exceeded that level. In the recent past, for instance, in 2021, we paid 61% of our net profit as dividend. In 2022, it was 56%, and so far we're running at 43%. Okay, so here we show you a lot of numbers. I'm not going to go into this. This is a reference slide. Okay, so this graph over here, we show you the total return to shareholders from the time we did our IPO in 1993 until 26th October 2023. So if you bought our share at the IPO, and if you held on to it, and you received all the dividends, and you reinvested all the dividends back into our stock, you would have earned a 15.84% sort of compounded return. So there's a publication called Splash 24/7. It's an online publication. We we've given a reference to the website where of the publication on this page. So they published an article entitled "Why Investing in Dry Bulk Companies is a Bad Idea." And to support their argument, they displayed the percentage drop in the value of a $10,000 investment at the time of IPO in various US listed dry bulk companies. And so we've just reproduced the data and the article, and it shows you that a $10,000 investment would have lost you potentially, in the worst case, 99.60% of your investment, and in the best case, 2% of investment. And of course, they overlooked PSL because this article was only on US listed dry bulk companies. But if they had included PSL, then they would have realized that a 10,000 baht investment in PSL's IPO in 1993 would be worth about almost 900,000 baht as of August, assuming, of course, all dividends are reinvested into PSL stock. So just some data on investor relations. We'll keep this as a reference slide. So just a bit on our ESG footprint. So some highlights of the quarter. So we were PSL during the quarter. We were one of 16 companies in Thailand that has been recognized as an outstanding climate action leading organization. We received an award from the Deputy Prime Minister a few months ago for this. So we're very proud of that. We were awarded a carbon neutral certification by the Thailand Greenhouse Gas Management Organization, or TGO. And we did this by offsetting in entirety our Scope 1 and Scope 2 emissions for the year 2022 by supporting a renewable energy project. We also were awarded Carbon Footprint for Organization by TGO. So just we've always historically we've always made the effort to try and reduce our emissions, and that's a big reason why we embarked on our program to order modern ships with eco engines, electronic engines, and that helped us reduce our average gram per CO2 ton from 12.884 in the year 2014 to 7.14 in 2022. Many of our ships are fitted with energy-saving devices such as Mavis ducts, pre-shrouded vanes, hub vortex, absorb fins, and each of these devices leads to energy savings of between 3 and 5%. In addition to that, we're also trialing a number of energy-saving techniques. So we are using we've begun installing sensors on several of our ships, and we are using the data from the sensor. We're using the help of using AI to help optimize the engines and also give us more early warnings when there are problems, so as to solve them. I'll just go through this quickly. So we provided in this year we provided a $1 million baht donation to Machai Patana. We continue to provide scholarships for students at the Merchant Marine Training Center in Thailand. We provide scholarships to about 42 students. We've also, this year, we instituted an academic and need-based scholarship program, and we gave 21 scholarships to school and college students. S&P, they ranked us in 2021. They ranked us as, they gave us the highest rank, ESG rank among all dry bulk companies that they rated, so listed dry bulk companies. For the year 2022, they did not break down the ranking by sort of company type. So we know that we were in the top 12 percentile of all global listed transportation companies in terms of ESG. We've received excellent corporate governance now for 14 consecutive years. The most recent one was just announced. And we were certified as a member of Thailand's private sector collective action coalition against corruption since August 2019. So some final food for thought. So we think that demand and supply are expected to be finely balanced over the next couple of years. As I mentioned, the supply pressures in particular have largely abated, and demand continues to, particularly in the minor bulk and grain segments, which comprises a major portion of the types of cargoes that we carry. That growth is quite secular. That's quite immune to the business cycle that we expect will continue to grow. IMF has just increased China's GDP in 2023 to 5.4% from 5%. So China continues to fire on all cylinders despite the negative news in respect to the property sector there. We're a Thai corporate, but we've really got zero business out of Thailand. Our ships are trading globally. The weaker the Thai baht, the stronger our EPS in Thai baht, as all our income is in US dollars. We think that price to book value is not a good measure anymore for us, for our stock, and as asset values have fluctuated significantly. Our debt continues to shrink, as you have seen. We are almost at 150 million of net debt, and that's, of course, we think should be good news for shareholders. Demand growth is in 2023 came in at a very well, it's expected to come in at a very healthy 4.59%. And a lot of this has been driven by China's economic recovery. The dry bulk fleet is expected to grow by 2.9% in 2023 and 2.2% in 2024. Also, we think net supply could actually reduce by about 1.5% to 2% on account of the new environmental regulations in relation called EEXI and CII. This is the final point. So we think climate change induced extreme weather events have increased actually 4 to 5 times since the 1970s. And this will result in more and more trade disruptions and increased ton-mile demand. So a prime example of this, which has been in the news quite a bit lately, is Panama Canal. The water levels in the Panama Canal have reduced quite substantially. They're expected to reduce further. And that will, of course, be very disruptive to ships. They'll have to sail much longer to their destinations. So with that, we open for questions.
Yeah, so there are 2 questions right now. The first question is about the El Nino problem at the Panama Canal, and how has this impacted the smaller ship size sector. So as Gautam just completed his presentation, he said that Panama Canal is going to actually reduce their daily transits from 36 ships down to 18 ships by the month of February. And they expect that the outages at the canal because of the lower water will continue till all the way till November next year. Now, when you say that you're cutting down the transit per day by that figure, by making it half, it means the ships will no longer want to go via Panama Canal and wait for days and days before they transit. Instead of that, they will sail a much longer ton-mile distance. And that will be very, very good for shipping. This is exactly what Gautam had tried to put across for you. The second question is that what is the rate outlook for next year? All I can do is to point out to you that Clarkson says that rates will grow by, the demand side will grow by 2.2%. And according to Clarkson's again, the supply growth will grow by 2.9%. Remember, these forecasts were made in October, where they had revised upward a lot of their numbers, but that was before the IMF came out and said that China's GDP growth rates would be higher at 5.4% compared to their last prediction, which was at 5%. So almost a 10% jump in the GDP of China between the last forecast by IMF and their most current forecast, which was released yesterday or day before yesterday. Obviously, Clarkson will now look at this thing and re-look at their models, and I guess they will increase the growth in ton-mile demand expected for 2023 and similarly for 2024. So that's all we can say. We ourselves don't make any forward-looking statements, and therefore we can't really comment on what's going on in the forward market on our own.
Maybe I can just add to the question on Panama Canal. So there's already been a reduction in the maximum number of ships that can pass through the Panama Canal. And the data that we have seen shows that it's the dry bulk ships and also to an extent tanker vessels which have been impacted most in terms of the number of crossings. These two vessel types, the number of ships that are crossing the Panama Canal has reduced the most compared to, let's say, the gas sector, which they're carrying much higher value cargoes and they have a much greater ability to pay higher canal fees, and there's an auction system, they can bid higher amounts. So there's already an impact on dry bulk. It's not a huge impact at this point of time, but we expect that there will be a greater impact in the coming days, certainly.
Just to give you some color on that, on the last thing that Gautam pointed out, a gas carrier, the client or the charterer of that ship bid for a canal slot and paid $2.85 million above the normal canal transit charges for that ship. So it just shows you how desperate people are getting when their ships come to the Panama Canal. Luckily for us in dry bulk, most of our ships are now not going towards the canal, they're all going round the Cape. And that means much, much longer ton miles, and which is much more beneficial than paying an extortionate price to the Panama Canal authorities.
คำถามที่เข้ามาจะมีเท่านี้ถ้าท่านใดมีคำถามเพิ่มเติมสามารถคีย์อินเข้ามาในระบบได้เลยนะคะ If anyone have any question can ask our คุณ Khalid and คุณ Gautam by key into the system. We still have 2-3 minutes more, so any question from the investor, please.ค่ะเดี๋ยวเราจะรอสักครู่นะคะเผื่อมีคำถามเพิ่มเติมเข้ามาค่ะ Does the company have any worry in anything?
The question that Som is asking me is that, is the company worried about anything? All I would say is that if you look at us in terms of our profitability during a very difficult period of time, where other competitors with scrubber-fitted ships, which are supposed to earn $3,000 more per day than our ships, they could not compete with us. They went into a loss of about $10 million for the quarter, whilst we came up with a profit of about $3 million for the quarter. So again, we think we are all right. We think we're doing well. We think that 2023 is a transition year. 2021 and 2022 were very strong years. 2023 is a weaker year compared to those 2 years. And we think, therefore, that once the weak year has passed and we come to a stronger market, we hope we can return to profitability as we had in the previous years. With that, we will end the presentation and thank you all so much for joining us. Adhika.